Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for the comments and subscribers. I greatly appreciate it. A big shout out to those taking my cash flow investing course. I'm getting great feedback on it. Thank you very much. This week, we are going to review Trulieve. It's part of the cannabis series that I am doing. Trulieve just announced that they were purchasing Harvest Cannabis. I was just about to review Trulieve when I saw the announcement and had to stop and pivot. So now I've pulled together financials for Trulieve. I pulled together financials for Harvest. I'm going to stitch them together and forecast just like I used to do when I was an investment banker. I'm going to present to you my analysis. Let's get to work. Fresh off the presses, this is the sunrise presentation that the investment bankers have released for the acquisition and merger of these two companies, Trulieve and Harvest. Let's click through it really quickly. I don't want to take too long with this. I want to dive into the numbers, but let's look at it just the same. Here is the announcement that they're combining. Here's some deal terms. They're saying that they will be one of the largest cannabis companies out there with the biggest footprint, $1.2 billion of consolidated revenue. EBITDA margins combined 37% with an adjusted EBITDA of $461 million next year. That's their estimate. Regions management, here's the combined entity. They're going to have 11 states that they're operating in, really make them a beast of a company. Here are the different brands that they operate under, and then the combined business, Harvest, Trulieve. This is revenue. They're going to combine to here. This is their big competitor. Here are some individual players within the spectrum of cannabis companies. And then on an EBITDA basis, here is Harvest, here is Trulieve. Combined, they're here. And again, here are competitions. That's generally what bankers do. And this is why I present EBITDA in my analysis, because investment bankers love to talk EBITDA, even though it's not true cash flow. It is the language of transactions in finance. That's why I use it. That's what they use it. Going through here's geographically what they're going to do. Some breakdown of the states. I'll let you guys read all that yourself. More brands and the management team. Harvest management team, Trulieve management team, and I'm going to give a big shout out to Kim Rivers, who is a phenomenal executive. She's doing a fantastic job. We're going to see that in a second. And I'm going to compare these two companies and then stitch them together and give you a forecast forward. But before we do, let's review the 5 key attributes that we look for all of our investing. Number 1, we need top line revenue growth. Number 2, we need EBITDA growth. That's enterprise level earnings. Number 3, we need strong cash flow. Number 4, we need low debt. Number 5, must buy it at an attractive price. We use enterprise value to EBITDA. Needs to be at a reasonable value. Doesn't have to be super cheap, but you don't want to pay too much for it. I haven't referenced this in a while, but go back and check out my Domino's versus Google IPO video I did last year. It shows that over the 15 years both those companies were public, Domino's actually outperformed Google as an investment if you bought it at the IPO and held it for the 15 years. It's very important not to pay too much for growth. All right, back to this. Let's dive into the financials. The first one I want to cover is Harvest. So behind me is the data that's available to them. This is millions in USD. And it's not too much, right? They went public fairly recently, so I couldn't pull too much historical, but basically $13 million of revenue in 2016, and revenue has grown strongly over these last years, 23, 47, 117, and $231 million of top line revenue growth for Harvest. Very good job. Here's like annualized growth rates of revenue off to the side here. So triple digit revenue growth, very impressive. Let's see if they could keep any of that in earnings. Lo and behold, they could not. We'll lay that at the feet of management. We'll get there in a second. But basically, weak profit here, and then when they went public, they started giving share-based compensation to their employees, and that is a monster number in their P&L. I'll get to it. $11 million loss, $74 million loss, and a $17 million loss on large revenue growth. That means that they're not profitable, and that's a big box for us that we look for when we're trying to buy a company. Growth rates of EBITDA doesn't really apply because it's negative. Let's move forward to enterprise value. There's not much data here, but I'm just going to show you for comparison reasons They do have debt despite not being profitable. They were able to borrow debt. That's not something we want to see, right? We want to see affordability of debt. We look for less than 3 times debt to EBITDA. Here's debt, EBITDA is negative. That number should be 0. But they do have it, and it's growing about a little over 1 times of revenue. That's a lot of debt for a company that's not making any money. Market cap is average share price times number of shares outstanding. Market cap about $1 billion, and it's fallen over this time as they've continued to underperform, have losses. Their market has come down. I'm assuming they went public in great fanfare, and as people realize, oops, they're not making any money, that's pulling back. Enterprise value is the sum of these two, and I get about $1 billion of enterprise value. It is a most recent company. With EBITDA negative, your valuation metrics here are kind of upside down because of the negative numbers. That's the revenue model. Let's look at cash flow for this business and see if they're making any cash flow. Cash flow from operations, that's what we want to look for. That's my favorite cash flow statement and your favorite cash flow statement. Cash flow from operations, weak positive numbers here, went public, large negatives. I guess when you're public, you're running on someone else's money, so why have profit? $16 million loss, $105 million loss, congratulations, and a $32 million loss. Those are hard cash numbers going out the door. They put money into CapEx, a lot of money, actually 100% of all negative free cash flow. So these doubled, right? So you're losing money making and selling your product, and then you're putting money into building new factories and facilities. So you've got bigger losses. How do you fund that loss? Well, you borrow debt and equity. So here's positive inflows of debt as they finance these losses. Free cash flow as a total number is a weak negative number, meaning they could probably fund most of it for cash on the balance sheet. Shares outstanding have been growing since they went public. This issuing of shares is bringing cash into the company to fund this remaining loss that they can't cover by debt. So they're in a weak financial position. They have strong revenue growth, which is fine, but they have large losses over the years. They've already fully levered the business. They can't borrow much more, and now they're selling equity to cover these losses. That's why this is up 130 million shares. That's almost a 50% increase in 2 years. That's a huge amount of dilution, and that's why you're seeing their stock price decline over time. And I think very astutely, this is why Kim Rivers and her team are looking at this business and saying, hey, maybe if I toss out management and I operate this business, I can do better than they can. Let's take a look at Trulieve's financials and get a better picture of how they run their business. All right, Trulieve's financials data. I've pulled as much data as I can because they're fairly recently public as well, so I can't get the full 9 years, but you're going to see a track record of performance that's markedly different from the previous management team that we just looked at. And the important thing here when comparing two companies, they both operate in the same industry. They're both facing the same industry challenges, being marijuana is not legal at the federal level. They have that problem. They have the banking problem because it's not legal. Banks have a hard time underwriting these deals. They have supply constraints. They have consumer prices, consumer packaging issues, brand identity. Everything that faces Trulieve faces Harvest, and you're going to see two different management teams handle that completely differently. Let's take a look. 2017, Trulieve, these are millions USD. These are the tickers that they operate under. $20 million of revenue, 103, 253, and $512 million of revenue. Congratulations. That is fantastic growth. Here's your annual growth rates, strong triple digits. So the same thing Harvest is doing, right? They're growing revenue, they're building out retail brands, they're doing what they need to do. Both seem very similar at this point. That's where the similarity ends. Here we go. EBITDA. Profitable, I'll consider it day one. I don't even have any revenue here. That's probably pre-revenue stage, but profitable in the EBITDA basis, day one, 38, 128, $248 million of EBITDA. Those are very strong margins, strong growth rate, a clear change in how the management handles the business. And I want to point to Kim Rivers. If you go to the website of Trulieve, go into the investor relations section. She has several interviews that she's posted on that website, and she does a phenomenal job of explaining exactly what she looks for in the business, how she operates it, how her job is to generate cash flow, how her job is to be profitable, how her job is to be prudent with debt. I mean, everything we talk about on this channel as a rational investor, she is pinging on her own investor relations page, and it's bearing out in our financial results, which is what we love to see. It means that our words are not just words, but she's actually acting on them. So let's move forward. They do have debt, but again, with profitable earnings, you can support debt, and that looks very good. It's basically 1 times each year, which is markedly different than Harvest, which had $300 million of debt and losing money. Then you've got market cap. Market cap, average share price times number of shares outstanding, $1 billion, roughly the same market cap when they went public as with Harvest, but it changed dramatically as these guys perform as they say they would and Harvest did not. Their market cap went up, Harvest went down. Big, big difference. Enterprise value, $4 billion for Trulieve. Market multiples, this seems very cheap to me, right? You got a profitable company, top line revenue growth growing at 3-digit revenue growth plus 100% annually. Trading historically at 16 times EBITDA, that seems very cheap. Low debt, less than 1 or about 1 times a debt to EBITDA, that also seems cheap. So I got a lot of checks the box here with management. Let's go check a look at cash flow and see how that stacks up. All right, cash flow from operations, CFO, here we go. It is profitable. It is moving in the right direction, very similar to the EBITDA. So that means the accounting team is expensing and recording revenue and costs in line with cash, which is a good thing. It doesn't mean it's cash accounting. It's still accrual accounting, but it means that they're representing the business appropriately. 2018, positive 24, 2019, 19, and 2020, $100 million of pure cash from running their business, which is fantastic. What do they put back in that business? Well, they put quite a lot. They put more than 100% of their cash into the business. So what does this mean? Well, they're in rapid growth mode, and their growth is dependent on retail locations, would take capital build out. This isn't software, so you would expect a growth company to have to reinvest in the business to continue to grow, and we're seeing that. But as you're saying it, the debt that they're borrowing to fund this gap, this $46 million shortfall, they fund with a very reasonable amount of debt, and they pay for the rest, of it with cash on hand. So here's the net cash flows. The cash flow to equity holder, what you and I base our valuation on, is on this number. And even though it's negative, you can see that they're generating enough profit in their business over time that they can afford that level of negative cash flow. They do raise a little bit of money by selling shares, because this is slightly negative. But you'll notice this is up only 10 million shares from the IPO to now, whereas Harvest was up 150 million shares. That is astronomical in its difference, and it's rational thought and protection of the capital from the investors, from us. If you and I buy this company, we sit in this number, and the more they issue, the more people dive into the pool to take part in this cash flow. So by keeping this low, it protects our interests, which is what we want to see. Harvest, on the other hand, was taking shareholders for granted. They were borrowing like crazy. They're selling their own stock like crazy. And as a result, people lost respect for the business and started backing away, and the share price continued to decline. That's how important this number is. Moving on, cash flow, free cash flow per share is slightly negative. I'm fine with that because they're growing, and we don't expect it to be negative forever. Share price, ROIC is strong, very strong at 30%. Yield is negative just because this number is negative. So then that is a tale of 2 different companies. And what's going on here is Kim Rivers and her team is saying, hey, we can operate our locations. I think they're in 6 states. that they can operate them extremely well. You can see it here in the difference. And what they're doing is they're looking out in the public market and they're saying, hey, Harvest has solid revenue growth. They have lots of locations in different states, but frankly, their management team is terrible. So if we buy them, we get the locations and we get the revenue. But then we take a Trulieve's management team and their disciplined capital approach and you push it into Harvest, they should be able to realize positive earnings from the Harvest operating entity that stack onto these. And I think that's going to make a great acquisition. Let's take a look. All right, now let's combine the two enterprises and take a look. Behind me, I've hidden out this line where I've combined both entities. I'll make this slightly different color so you can tell what I'm talking about. So this line here is both Harvest and Trulieve's 2020 results combined. And as a combined entity, they should do $753 million of revenue last year, 2020. They would have produced $231 million of EBITDA, again, slightly down because EBITDA is negative. Even though if you look in the financial statements for Harvest, they show a positive EBITDA. That's because they adjust their numbers and they have tremendous share-based comp. In fact, let me go to that right now and show you the difference in mentality, how they treat shareholders. Let's pivot right now and go to the income statement of both companies. Here we go. Harvest Health and Recreation Company, Cannabis Company. This is the 2020 cash income statement. Share-based compensation, $20 million, right? That's roughly 10% of revenue that they are paying their employees to stay and work in the business. And when they do their adjusted EBITDA number, like so many other software garbage companies do, they add this back and they pretend, oh no, that didn't actually happen. Well, it really is. It is a fact of life that if you're paying employees this number, they're working at the company because they want that compensation. That's part of their comp package. If you didn't pay it, they would leave the company. So you can't add that back at EBITDA. We do not this channel. So I expense that. That's why my EBITDA is lower than the EBITDA that Harvest publishes because I'm not allowing them to add that back. Now let's take a look at Trulieve and see a difference in management style. So Trulieve's cash flow statement, I'm pulling the cash flow to get share-based comp because they don't break it out in the P&L, but I can get it here at the cash flow statement. The share-based compensation, $2.7 million. Roughly 10% of what Harvest gives out, these guys are giving out. On what revenue? What did I say, 500 million of revenue? Well, yeah, 520 million of revenue. They gave out 2.7 million. That's what, 2% of revenue. Trulieve is giving their employees a stock-based comp, but Harvest is giving them 10% of revenue. That is a big difference in management, and that is what I believe Trulieve will push into the new company. If those employees at Harvest leave, so be it. That's synergies that these guys will use to boost margin. Kudos to them. All right, back to here. Let's look at the combined enterprise. So here I have a negative number, $231 million of EBITDA. Let's take a look by going over debt. The debt goes up, right, because Harvest is fully leveraged, 624. Market cap. Now, market cap is shares outstanding times price for both companies. I'm using $4 for Harvest because that's where the stock went to. And right after the announcement, the Trulieve's number dropped. So I'm using the lower market cap for Trulieve as a combined number, and I get an enterprise value and a market multiple of 30x. So you're paying, if you buy it post-merger or post-announcement because it's trading for the merger, you're at 30 times, which again, I don't think is too high of a number. I'll explain why in a little bit, but I still think that's a reasonable multiple given how much EBITDA they can shake out of Harvest when they turn that company around. All right, just for fun, let's go through the cash flow statement just quickly. $68 million of free cash flow of operations, so it's positive even after the combination. CapEx, again, very heavy investment. Both companies are now fully invested, so that number's gonna be really big. Borrowing, slightly positive again because Harvest was borrowing, so that's probably positive. a negative $52 million cash flow. Not too bad for these kind of combined companies to be able to finance. They will finance it with equity. This equity reflects the fully diluted shares outstanding of Trulieve after the combination of Harvest. So if I go in here and I look at my comment, or rather just the math behind it, right? This is the shares exchange ratio that's published in the announcement, 0.117 Harvest share for every Trulieve share that they exchange into. So I'm taking Trulieve shares plus all of Harvest times 0.117, and I get a new $162 million shares. So I use this for the market cap going forward. But the rest of it doesn't matter too much to me because we know that the cash flow is negative because they're growing. Okay, now we have looked at both companies. We have looked at Harvest and we're like, great, it's top line revenue growth, awesome. Nothing else checks the box. Trulieve, everything checks the box. Top line revenue growth, EBITDA is positive, strong free cash flow is good. It's strong. They're putting a lot because they're growing, but I'll still check the box that's good. Low debt and well priced. So now what do? Now we've looked at both businesses. We've realized the one is stronger than the other. Now let's forecast. Okay, here's the forecast model. These are my assumptions for the business. I've checked it with that deck that they released that I went through earlier, and they roughly tie, which was nice to see, but I did this on my own, and they're roughly tied to the numbers that they publish as their forward guidance by simply stitching the businesses together. And what I'm getting is I'm growing this number by 60% of revenue growth to get $1.2 billion of combined revenue in 2021. And I'm doing 60% because both companies are growing at over 100% or triple digits every single year for the last 3 years. I think it's very realistic that it's going to continue to some degree, but I'm still haircutting it to be conservative to protect my own capital. I'm not going to give them credit for a full 100% growth. I'm going to scale that back and I'm going to bring it down over time as the industry matures, as it becomes harder to find acquisitions. Growth is naturally going to slow, and I don't want to pay for that. They can beat this, that's fantastic, but I don't want to pay for it in my price. So 60% and bring this down. I'm going to vary this number for you in a sensitivity table afterwards, but just keep in mind I start with 60 and I drop it 5% every year over time to get $17 billion 10 years out of revenue. EBITDA margin, I start at 30%. Which is basically kind of the percent that they're giving in their forecast. It's also the same percent that I get right here when I combine the two businesses. And I bring that down. I bring the profitability percentage down over time because I think commoditization, competition will erode margin as this becomes legalized at the federal level. There will be more players that will come into the market. So I think this strong margin will come down over time. But it gives us a very rosy number of $2.8 billion long-term EBITDA target that we're going to put into our forecast and forecast forward. Okay, the EBITDA growth forecast is $370 million for next year. That's simply combining the two enterprises and giving that growth that I showed you earlier at a 35% margin. I then shrink that margin over time to compensate for new entrants into the market. You might even say that's conservative if Trulieve is able to synergize by shedding some of the management at Harvest over time and fully embodying the Trulieve operating mentality into those assets. You could argue that this number should be higher, but I'm leaving it for what it is. 25 times enterprise value EBITDA multiple. That's less than what's currently trading at. So I'm actually contracting EBITDA market multiple over time, which I think is another conservative notch. 2x debt gives me about $4 billion of debt. Subtract these two, I get $50 billion of market cap out 10 years. Roughly 200 million shares outstanding is my estimate in the future. I get that by taking the 160 million shares they currently have, and I continue a small bit of dilution that Trulieve has done in the past, about 2% every year, and I get this long-term number. They will need that to grow. For the growth cap, there will be some dilution. When I divide these two, I get a long-term price target of $247 per share out 10 years, which is a very strong number. Let's take a look at cash flow and forecast that. Okay, behind me is the cash flow forecast. I'm leaving it blank because they're growing. They're not going to pay any dividend, and most of their cash flow right now is negative as every free dollar goes into CapEx to grow and expand. I want them to continue to do that and not kick out any money. So I'm not having any cash flow. I'm going to say in the end, in 2030, I'll take the EBITDA number and I'm going to assume 50% goes to CapEx, and what's left over I can divide by my share outstanding forecast, and I get $5.38 per share. Again, that is EBITDA less 50%, which I'm assuming is CapEx. So it's kind of like an EBITDA meets CapEx. We also smell checked cash flow from operations against EBITDA, and they were fairly in line with another with Trulieve. So I think taking EBITDA less CapEx is a reasonable approach. Not perfect, but this is out 10 years. 2% yield gives me a price target of $286 per share long term. Okay, now that we have fully understood what we think this business Trulieve and this business Harvest have performed in the past, and what we think they're worth when we stitch them together, let's see what we can buy this for in the public market. Well, if you look out right now, you can pick up Trulieve shares at $40 a share, roughly. Might be a little less than that actually right now because they just announced the news, but basically $40. And I'm saying in the long term, I think this stock is worth $258 long term when they stitch this together. And big caveat here, because marijuana is federally still illegal, they're going to need some kind of legalization nationwide to really fully realize this. But nevertheless, I'm assuming that happens in the next decade. And so that's the number that I'm coming up with. Let's put this in an IRR calculation, see what kind of return we get. Again, I'm buying it at $40. I'm not assuming any cash flow distributions. As they grow, it's still highly uncertain, and this is still an over-the-counter stock, so anything can happen. I'm not going to give any credit here for cash flow. Fully burden the IRR with no intermediate cash flow. So I buy it at $40, I sell it at $258, and I get an annualized return of 23% every single year, or about 6 times my money, which is an amazing return for this stock. I think this Trulieve is very cheap. I liked it before the announcement of this merger. I like it even more now after the merger. And I think there's strong upside here. I will just show you in a second. Let's recap our 5 key attributes. So top line revenue growth for this combined entity, yes, it's there. EBITDA, it's strong and it's positive, yes. Strong free cash flow, yes. Cash flow from operations is strong. They have high CapEx, but I'll give it to them, check the box. Low debt, absolutely. And well priced, yes. Even at 29x EBITDA, I think it's cheap. Given the amount of growth that they're experiencing for such a fledgling industry, I think this business is cheap, and I would definitely buy this stock. In fact, I am buying it as we speak. So I'm going to give this a good. It's my highest rating that I do because I'm a conservative guy. There's just, good. That's all I give it. But I do like the stock, and I think it's got strong upside potential if you're looking to buy and hold something long term. Now, as I always do, I like to give sensitivity tables. This is a rather robust example of one, but I wanted to play with it because there is so much variability here with what could happen in the future. I had to expand the I had to expand the boxes a little bit. So what are we looking at? You've got stock price up top. $40 is what I'm buying at it currently. If the stock rises, these are my IRRs. If the stock falls, these are my IRRs. And remember I told you earlier the growth model. I was using 60% for next year top line revenue growth, and I bring that down 5% every year. Here's the 60%, and I vary it by lowering it or increasing. So if they grow higher than expected, more like what they have been historically, or to be conservative, something happens and they grow slower, this gives me a distribution box of what the IRR could look like over time. And I think you're in this range someplace. Who knows, right? This is math behind me. Nobody knows what the future holds, but it gives me comfort that even on my base case, I'm still at a healthy, above market beating return, which is I want for such a risk reward profile such as this stock. Then I simply repeated it here. Some people have trouble conceptualizing what an IRR means over time, that compounding has a big impact on your return, but it's hard to conceptualize between 23% and 18%. What does that really mean? So I put it here like a cash on cash return. So I'm saying I put in 40, I get out 250, that's 6.6 times. If I underperform, I make 4.5 times my money. If I outperform, I'm about 10x my money, which is a great idea for me. I like seeing 10 times numbers. That's a big one that some of my mentors go for, those 10 baggers, and I think that's an option here. We'll see how this plays out in 10 years, but I definitely like it. So my name is Cameron Stewart, CFA. This is Rational Investing. This is a review of Trulieve. I know it's a little long, but I appreciate you sticking with me, and I hope you enjoyed it. If you want to know how to do analysis like this, please check out my cash flow investing course, How to Buy Cash Flow in the Stock Market. The description's down below. You can also go to cashflowinvestingpro.com for the course and the details. Let me know what you think about this review. Comment down below. I want to give a big thank you to the channel. Everybody out there, you came up and pointed me to Trulieve. As soon as I looked at it, as soon as I listened to Kim River speak, I was like, this is a fantastic stock, and we got to check this thing out, and I really, really like it. So tell me what you think. I'm happy to have the feedback, and let me know what you want to do next. My name is Cameron Stewart. Thank you very much. Bye-bye.